We all know the market moves in three trends: uptrend, sideways, or downtrend. But in reality, it's not that simple. The real challenge isn't just spotting whether price is trending or ranging, it's recognizing the right swing points and understanding the story behind each move. Once you train your eyes to read market structure the way institutions do, everything changes. The charts stop looking random, and every move starts to make perfect sense. In this video, we are going to talk about market structure, covering the accumulation, manipulation, and distribution phases, identifying strong and weak swings, and understanding the market structure shift. By the end of this video, you'll have complete clarity on key components of market structure, helping you analyze the market with confidence and eliminate confusion in your future trading decisions. If you are interested in learning advanced trading concepts, strategies, entry techniques, and how to control your trading psychology to stay disciplined in your trading journey, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. The market moves in cycles, not straight lines. There are three core stages in every cycle: accumulation, manipulation, and distribution. In accumulation, institutions quietly build their positions. Price usually moves sideways, trapping impatient traders who think nothing is happening. But this is where the groundwork for the next big move is being laid. Then comes manipulation, the stage where smart money fakes direction. Price sweeps liquidity, hits stop losses, and triggers false breakouts to collect orders from both sides. This is where most retail traders get trapped, buying the top or selling the bottom. Finally, we enter distribution, the real move. This is when institutions drive price in the intended direction, after building enough liquidity and volume during the earlier stages. Once the move matures, the cycle repeats, leading into another accumulation phase. Recognizing these cycles helps you understand why price behaves the way it does before major moves occur. Together, these cycles create impulsive and corrective moves. An impulsive move is a strong, decisive push in the direction of the overall trend. It's driven by institutional order flow, the big players entering or adding to their positions. On the other hand, a corrective move is the market's way of taking a breath. It's a temporary pause or retracement against the main trend, where price consolidates, retraces, or moves sideways. During this phase, the market is collecting liquidity and preparing for the next impulsive leg. When an impulsive move is strong enough to break above a previous swing high in an uptrend or below a previous swing low in a downtrend, that's called a break of structure. This break confirms that the existing trend is continuing. But not every candle that pierces a level is a valid boss. For a valid break of structure, price must close decisively beyond the previous swing point, showing clear momentum and intent. A simple wick through the level isn't enough, we need confirmation that the market has shifted energy and direction through a strong close. After the break of structure, new swing points begin to form. A swing low is the valley where price fails to go lower and begins to rise again. A swing high is the peak of a move where price fails to go higher and starts to reverse. In an uptrend, we see a clear sequence of higher highs and higher lows, showing that buyers are in control. In a downtrend, price forms lower lows and lower highs, showing that sellers dominate. These swings define the rhythm of the market and help traders identify structure shifts and entry points with precision. Within the major swing highs and lows, known as the external structure, the market constantly forms smaller movements inside, called the internal structure. These are the minor swings, made up of smaller impulses and corrections that create short-term fluctuations within the larger trend. While the internal structure shifts more frequently, the external structure holds far greater significance, representing major turning points in the market. These levels can't be broken easily without strong institutional order flow driving the move. A valid corrective move is one that retraces deeply enough to sweep liquidity below the minor lows. This sweep is essential because it provides the liquidity, the fuel, needed for the next impulsive move. However, if price fails to break those internal lows, the correction is considered invalid. This means the market hasn't collected enough liquidity to fuel the next move, indicating that the pullback lacks depth and strength. In this case, we don't treat it as a proper correction but rather as part of a single impulsive leg, showing that momentum is still intact in the dominant direction. A market structure shift happens when price transitions from one dominant trend to another, for example, when an uptrend starts showing signs of reversal into a downtrend, or vice versa. In a bearish market structure shift, price stops making higher highs and breaks below previous swing lows, showing that sellers have taken over. In a bullish market structure shift, price stops making lower lows and begins to break previous swing highs, signaling that buyers are gaining control. But not every shift is valid. A valid market structure shift must originate from a higher time frame point of interest, such as a supply, demand, order block, fair value gap, breaker block, or mitigation block. When a shift aligns with one of these institutional footprints, it confirms that the market is not just retracing, but truly reversing direction with institutional intent. To catch an impulsive move, understanding market structure is absolutely essential. Without it, you're like a person walking blindfolded through a city, moving but without any sense of direction or awareness of where you truly are. Market structure acts as your map. It shows you where price has been, where it is now, and where it's most likely to go next. By reading structure correctly, you can identify high-probability zones, define your risk and reward, and execute trades with confidence rather than guesswork. In short, understanding market structure doesn't just help you find entries, it helps you trade with purpose, precision, and control. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.